How to invest nowadays. Sophie used to be not willing to invest because that is how her parents taught her. Get good grades and get a good and stable job and save. However, Sophie achieved all that, she still can't achieve savings. While her parents, who used to own business in China, managed to give down payment for Sophia house in Canada. How Sophie have some money put aside nowadays. When Sophie comes across the Poor and Rich Dad books, she started to get financial education that has not been taught in school. Gradually, Sophie under the 7 real estate strategies. Based on Robert Kiyosaki's Rich Dad, Poor Dad philosophy and related strategies from his teachings, here are 7 real estate investment approaches aligned with his principles, along with critical insights and alternatives. 1. BRRRR method. Buy, rehab, rent, refinance, repeat. A cornerstone of Kiyosaki's strategy, this advanced method focuses on leveraging equity from renovated properties to fund future investments. Buy. Acquire undervalued or distressed properties below market value. Rehab. Renovate to increase property value and rental appeal. Renter. Generate steady cash flow through tenants. Financier. Use the property's increased equity to secure a cash-out refinance, recovering initial capital. Repeat. Reinvest the funds into new properties. Refinance builds passive income and scalable wealth. This requires expertise in property valuation, renovation budgeting, and debt management. Not ideal for beginners. 2. Value-add investments. Buy below market plus improve. Kiyosaki emphasizes purchasing properties with potential for improvement. Target distressed homes or under-commercialized assets in your local market. Calculate renovation costs upfront to ensure the total investment, purchase plus rehab, remains below post-improvement market value. Example: a $300K property needing $50K in upgrades could appraise at $400K, creating $50K in equity. Key insight: focus on properties with a clear path to profitability through upgrades or rezoning. Percent 23. Multifamily properties for cash flow stability. Kiyosaki advocates for NAOR, multi-unit properties. Duplexes, triplexes to mitigate vacancy risk. Spread expenses, maintenance, mortgages across multiple tenants. Higher occupancy rates ensure consistent cash flow even if one unit is vacant. Example: a 4-unit building generates 2,000 unit monthly, totaling $8,000 versus single-family home's $3,000. 4. Market cycle timing. Align purchases with the real estate cycle and phases. Recovery on bottom phases. Buy during downturns when prices are low and vacancies high. Done expansion phase. Refinance or sell assets before peaks. Example: post-2008. Investors who bought foreclosures during the bottom phase saw massive appreciation. Kiyosaki's advice: profits are made in the buying, not the selling. BRRRR 5. Tax-advantaged structuring. Use corporations, LLCs, S-Corp, to optimize taxes and liability. Deduct expenses, repairs, property management, depreciation against rental income. Their cash flow first. Prioritize properties where rental income covers expenses after tax deductions. Example: a 4,000-month rental property with $3,000 in expenses and $1,000 in depreciation can show $0 taxable income. BRRRR 6. Leverage other people's money, OPM. Minimize personal capital by using loans, partnerships, or private lenders. Low down payments. Aim for 20% or less, using bank loans or hard money. Over-leverage can lead to disaster during market downturns, e.g. 2008 crash. Kiyosaki's balance. Use debt strategically but maintain reserves for vacancies or repairs. BRRRR 7. Build a professional team. Kiyosaki stresses outsourcing to experts. Property managers. Handle tenant issues and maintenance. Forex advisors, optimize deductions and entity structuring. Contractors. Ensure cost-effective renovations. Key insight: the rich focus on their asset columns, not doing everything themselves. Critical considerations and alternatives. 1. Diversify beyond real estate. Critics argue Kiyosaki overemphasizes real estate. Balance with stocks, bonds, or index funds. Avoid over-leverage. High debt magnifies losses during downturns. 3. Passive income alternatives. Short-term rentals, Airbnb. Higher income potential but requires active management. REITs, real estate syndications. Passive exposure without direct property ownership. Final takeaway. Kiyosaki's strategies prioritize cash flow, leverage, and financial education, but require caution with debt and market timing. Pair his methods with diversification and risk management to build sustainable wealth.